Palantir shares exploded by nearly 30% yesterday after reporting otherworldly 93% revenue growth. Yet advanced micro devices crashed over 6% today despite beating revenue expectations. The stock market is sending a brutal, uncompromising message to global investors. Revenue beats are no longer enough to keep stock prices climbing. Wall Street now demands immediate profit conversion from every single dollar spent. Welcome to the newest phase of global earnings season. The market reaction across the United States, Europe, and the UK has completely shifted. Palantir blew past every Wall Street consensus metric. Commercial AI adoption accelerated faster than analysts predicted. Management raised full-year guidance across the board. Investors flooded in, pushing the stock to massive new record territory. However, look at what happened to AMD today. The chipmaker delivered strong artificial intelligence hardware sales. They forecasted higher upcoming quarterly revenue than consensus models suggested. Yet traders sold off the stock aggressively right after the bell. Why did a double beat trigger a 6% sell-off? Because the stock had already rallied over 100% this year. Expectations were set at absolute perfection. Any valuation stretched that then requires monumental guidance to sustain momentum. SpaceX faced an almost identical outcome in its debut post-IPO earnings release. Satellite communications revenue nearly doubled year over year. Operating losses narrowed significantly. Still, the stock dropped over 7% in trading. Executives confirmed that capital expenditures for space and AI infrastructure will stay massive. Free cash flow concerns immediately spooked institutional traders. Wall Street is punishing heavy spenders while rewarding software platforms with high margins. Before you skip to the end, the real shocker came from a traditional industrial giant. Caterpillar delivered one of the most surprising earnings reports of the entire week. Shares soared nearly 10% in early trading yesterday. Quarterly sales topped $20 billion for the first time in history. Most retail investors view Caterpillar as just a heavy machinery manufacturer. They completely missed the hidden catalyst inside their earnings report. The primary driver was not just highway or housing construction. It was their energy and power generator division. Artificial intelligence data centers require tremendous amounts of reliable electric power. Tech companies are buying Caterpillar turbines in record quantities to keep facilities running. This creates a clear, actionable trade for global investors. Do not limit your exposure purely to semiconductor manufacturers. Look at the industrial grid providers building physical support systems. Infrastructure companies are capturing massive AI revenue without extreme software valuations. What most people don't know is how European markets played out today. Across the Atlantic, the European STOXX 600 index pushed to new record highs. German pharmaceutical giant Bayer jumped 3% after posting an unexpected profit increase. In the UK, oil heavyweight BP traded higher after beating quarterly cash estimates. However, the European retail sector told a starkly different story. E-commerce titan Zalando plunged 16% in a single trading session. Management slashed their full-year sales outlook due to weakening consumer demand. European airlines like Lufthansa also fell due to volatile jet fuel costs. This split reveals a crucial economic dynamic. Global consumers are aggressively trimming discretionary spending on apparel and luxury goods. Yet essential sectors like healthcare and energy continue generating robust operational cash flows. If you want daily institutional-grade market updates like this, hit the subscribe button right now. Returning to U.S. healthcare, drug maker Eli Lilly gained nearly 3% today. Management raised their full-year revenue target due to surging global demand. Essential healthcare stocks are providing strong defensive growth while tech shares fluctuate. Meanwhile, consumer discretionary stocks continue showing visible warning signs. McDonald's reported a modest earnings per share beat yesterday morning, yet U.S. same-store sales growth slowed sharply to just 0.8%. High gasoline prices and persistent inflation are hitting lower-income consumers hard. Rideshare leader Uber dropped over 6% after issuing disappointing profit guidance. Drivers are paying higher operating costs while passenger booking growth cools down. The market is rewarding pricing power and punishing fee contraction. Companies that cannot pass cost increases to customers are seeing margins collapse. The surprising part comes next when we connect all these individual moves together. Broad index buying is becoming a risky strategy at current record valuation levels. You must analyze earnings quality at the individual stock level. First, watch capital expenditure trends very closely. If a tech company increases capital spending without boosting near-term revenue, stay cautious. Second, monitor indirect infrastructure plays. Power equipment suppliers and grid developers are capturing direct revenue right now. Third, balance high-growth tech with steady cash flow defensive leaders. Pharmaceuticals and essential energy providers offer strong downside protection. Earnings season has made one thing crystal clear. Stock picking and strict risk management will define the rest of this quarter. Look out for our next video posted daily.